Hello everyone, and welcome to another episode of The Theory Behind Investing. Our engaging videos will guide you through the fundamentals of investing and help you to understand what happens in the stock markets. If you like this video, please subscribe to our channel to remain up to date when we publish new contents. Today, we'll explain what is a short squeeze, a word you might have heard in the last days after the impressive performance of shares like GameStop, AMC, or Bed Bath & Beyond. By the end of this short video, you'll be able to understand headlines such as GameStop shares rise sharply amid short squeeze, hedge funds forced to close short position, or retail traders take on Wall Street. Let's go step by step. To understand all of that, we first need to master what long and short selling mean, what causes a short squeeze, and the role of retail traders in all of this. Going long on share is the classic investing approach, where you buy a share hoping its price will increase over time. Your strategy is to buy low and sell at a higher price. The shares you buy are yours, and in the worst case, you will lose a maximum amount equal to your investment, because the lowest value a share can go is zero. Going short, or short selling, is the opposite approach, but with an important difference. First, you do not own your shares, but you borrow them from a broker. This means that you ultimately need to give them back at a given moment. Your strategy is to sell the shares you borrow at a high price and buy them and return them to the lender at a lower price. So you earn money if the value of the share goes down. This approach is speculative and inherently risky because there is no upper limit for the value of a share. Consequently, as a short seller, you can lose an infinite amount of money if prices keep going up. So, what is a short squeeze? Well, imagine that you are a short seller. You hope the share price will go down, but in reality, the price goes exactly in the opposite direction. When this happens, you are not in an ideal spot. You are losing money, you already sold your shares, so you are obliged at a given point to repurchase them, and you panic, because the higher the price goes, the higher the losses. If the price increase is significant, your world can definitely tear apart. Your only chance is to rebuy the shares as soon as possible to limit your losses. So you try to buy, but the higher the number of buyers, the higher the demand, so your purchase pushes the price even higher. With this reaction, you are obliged to behave against your initial strategy. You wanted to speculate, but you are now contributing to an increase in the share price, because losing something for you is definitely better than losing everything. This is then when we have a short squeeze, that is, when the market is squeezing the short sellers, forcing them to desperately buy at higher prices to cover their losses. So why are we listening a lot about the role of retail investors? Well, few hedge funds were speculating on the future of companies whose business is being affected by the pandemic. Those hedge funds place billions and billions of short positions in GameStop, AMC, or Bed Bath & Beyond. On the other side, a large group of small retail investors began to fight back. They all put a small or relatively small amount of money and started buying the stock. So remember, the higher the demand, the higher the share price. And the higher the share price, the more short sellers are obliged to close their position and buy the share back, contributing to even higher prices. So the power of collective pushed the share of these companies to the roof, with gain of triple or quadruple digits. We hope that these few minutes help you to increase your knowledge. If you wish to learn more about the theory behind investing, feel free to subscribe to our channel or simply put a like or leave a comment. Thanks a lot for your attention.